Welcome to our first webinar in our series of money workouts for women. I am Leanne Knight, the Director of Wealth Management at North American Management, and I'll be your speaker today. We're planning to host these webinars on different topics about once a month through the end of the year. I'll be sure to show you the future topics and dates at the end of this session. A couple of housekeeping items before we start. We have a fairly large crowd online today, so I've put everyone on mute. But we want to make sure we get your questions on investments answered. So if you have any questions during this webinar, please feel free to write them in the question box on your GoToWebinar screen. Okay, so what are we going to cover today? We're certainly going to go through several definitions that we often hear, of words we often hear around investing. We'll talk about some benefits and risks to different types of investments. And I certainly want to provide you with some things to think about regarding your own portfolios and how to construct those. This is not going to be a deep dive into investment theory or research, but hopefully it will give you a start on a better understanding of your investments. So here we go. So I promise I won't keep you on this webinar for 3 hours. I'm going to try to keep it to an hour, but I'll stay on for a while at the conclusion if you have any questions. All right, so as you may suspect, women and men often approach investing differently. I thought I would share a few statistics with you. On the left, you can see a chart here from Vanguard. Vanguard did a study in 2015 on savings rates in 401k plans and found that women actually save anywhere from 7 to 16% more of their salary than men do. So women are good savers. Another interesting data point's on the right, and this chart comes from Fidelity. Fidelity did a study just last year and found that women actually average a slightly higher return than men on similar portfolios. Fidelity attributed some of this to the fact that men trade their investments more frequently and women tend to be more patient investors. So what does an increase of 0.4% really mean over the life of your career? Well, for example, if you started with a $100,000 portfolio and it returned 7.4% on average versus just 7% over 30 years, you would have close to an extra $100,000 in your account at the end. So it does add up. But that said, that career lifetime might not really be 30 years. Less generally get saved by women for retirement simply because they work on average fewer years than men and certainly take time off for children, families, etc., and go in and out of the workforce more frequently than men. We've heard a lot recently and not so recently about this ongoing wage gap. The Institute for Women's Policy Research found that for every dollar earned by a man, a woman earns 80 cents in the same job. So while we may be saving more of our paycheck in 401k plans, we may not be starting with the same paycheck as a man. Women also tend to live longer than men, which means those savings need to last longer in retirement. There's more of a strain on the resources. The Social Security Administration recently did a study, and they actually update this on a regular basis, but they assume not only will women live an average of 3 years longer than men, the difference between 87 and 84, but that you actually have a 1 in 10 chance of living to age 95. So retirements are definitely lasting longer. And despite the previous slide where women and men with similar portfolios result in women getting a higher return, many women actually invest more conservatively than men, which means their portfolios can grow more slowly. So, as they say, knowledge is power. The more you understand about investing, the more likely you'll be able to adequately plan for some of these pitfalls we've identified. Okay, before we talk about specific types of investments, it's important to really learn the first rule of investing, and that is to be diversified. And here's why diversification works best as an investor. If you take a look at this chart, this is often known as an Ibbotson chart, or a heat map. There are different terms for it, but it really shows the return of different asset classes in any given year. And by asset classes, I mean the small stocks, large stocks, international stocks in red, long-term government bonds, treasury bills, and then we're going to talk for a minute about what a diversified portfolio of all of those might have looked like. But if you can look at 1998, at the top of 1998, you can see that the highest return that year was large stocks, large cap stocks. And then in 1999, the highest was small cap stocks. So again, very different asset classes at the top. I always like to point out really what happened in '08 and '09 because we are all still, most of us anyway, still familiar with that period of the markets. In 2008, the highest returning asset class was long-term government bonds, very safe government bonds. 2009, what happened to government bonds? They were literally the lowest returning asset class. And in fact, again, 2008, the lowest or the worst performing were international stocks. And yet in 2009, they were the best performing. So again, it's hard sometimes to predict which one of these classes is going to be at the top and the bottom. So that's why typically long-term investors will try and have a diversified portfolio, and you can actually see the returns of a diversified portfolio of all these asset classes in the gray boxes. So pretty much in the middle of those of the chart. Don't do as well as the highest performing, but typically don't fall as far as the lowest performing. Absolutely, in 2008, you would have still lost money even in a diversified portfolio, but the following year you would have gained quite a bit of that back. So let's be sure to keep this in mind as we dive a little deeper into individual investments. So, what is a stock exactly? We certainly hear this term all the time. Stock is really just a share of ownership in a company. You sometimes hear stocks called equities as well. That's kind of an interchangeable term. They can be issued by large companies, small companies, companies that operate in the US or internationally. So again, just think of it as having a little piece of ownership in a particular company. So why own stocks? Well, we're going to talk a little bit about the pros and the reasons to own stocks, but we're also going to talk about some of the risks that you might have to take with stocks. Stocks really contribute to your portfolio in two ways. It gives you a chance to own profitable, growing businesses that will increase in value as you go into the future. And some stocks, many stocks, pay dividends. And so, therefore, you could also have some current income from that stock ownership in the form of dividends. And we'll talk a little bit more about dividends and how they work a little bit later on. Not all companies pay dividends, though, so it's important to know if a company you're looking at does or not. Um, for those who do, dividends typically range from less than 1% of the value that you've put into the stock to up to, say, 3%. So if you think about putting that same money to work in a bank account, compare that to the rates you would earn in a checking or money market, just to give you a sense of what kind of return you would be getting on the dividends from a stock. Um, I also mentioned inflation protection here. I think inflation protection is really one of the most important things that stocks can provide to you. Inflation, in simple terms, is really just how much the cost of the same goods goes up each year. Historically, the inflation rate's been close to 3%. Currently, it's a little bit lower than that. I think it's around 2.2. So, for example, if you have a basket of groceries that cost $100 today, next year that same basket is going to cost you $102.20. The third year, that same basket of groceries is going to cost you $104.40. So if your investments aren't growing enough to keep up with those rising costs, the amount of groceries you can buy is going to keep diminishing. And I know no one here wants to live on cat food in their old age. So we want to make sure we have something in our portfolio or enough stocks in our portfolio that we can keep up with inflation. One of the other things we find very attractive about individual stocks is the tax efficiency or benefit. One is, which is mainly that you don't have to recognize any capital gains on the growth of individual stocks in your portfolio until you actually sell that stock. So no capital gains means no tax. Dividends, if the stock does also pay dividends right now, dividends, that income is taxed at a preferential rate or a lower rate than other types of income might be taxed on your tax return. So what are the downsides to owning stock? Well, if you only own one or two individual stocks, you've got a lot of risk, or what we call concentration risk. You're basically putting all your eggs in one basket, and if something happens to that individual company, you really might lose all of the money that you put in there. So if you're going to have a portfolio of individual stocks, you really want to have enough of those stocks in different industries and in different sizes. And we're going to talk a little bit about how you determine the different sizes of companies and stocks. You probably also want to have stocks from a variety of geographic locations. So, uh, not everything from one companies in one state or in one industry. Because certainly if the company goes under, your investment uh, will likely be worthless. Um, some companies don't pay dividends. There's nothing wrong with that. Those are companies that are probably a little bit younger, wanting faster growing. They want to be able to plow all their excess money or profits back into their company, so they're not quite willing yet to pay out dividends to their shareholders. So that doesn't mean there's anything wrong with them. It just means that's what they're focused on growing. So if you needed income today, you may not want to have all of your money in stocks that do not pay any dividends. Um, and then, of course, anytime you're investing in individual stocks, it does require monitoring and reading, including reading financial statements as well as other financial information to really make sure you understand what's happening in that company and the financial health of that company. Okay, so let's say you are interested in investing in a few individual stocks and you want to understand a little bit better how to read an actual stock quote. This doesn't tell you everything about the company, but it will cover a few things that will be helpful to you if you were researching a company. The example I've used here is Apple because everybody knows that company, and it is for example purposes only. So the first thing you see here in the biggest font is the price of Apple stock on the day that I captured this screenshot. And it even tells you at what time. This was about 1 o'clock in the afternoon on March 26, 2018. And the price right then was trading at $168.99 for a single share of Apple stock. What we can tell here from this chart is that that day, March 26th, at that time, the stock was already up about 2.5%. that day from where it had started the night before. So Apple was having a good day that day. Um, so the if you look at the volume numbers below that, let's talk a little bit about that. So as you can see, it says volume 18.5 million. That's how many shares have been trading in Apple stock that day. That sounds like a really pretty big number. And in fact, the 65-day average volume of Apple shares is close to 36 million shares a day. Now, you can compare that to the average daily volume of the Dow Jones Industrial Average stocks, which is only about 24 million. So that starts to tell you that, Apple seems to trade quite a bit. That's usually a good thing in that it makes it very easy to trade if you want to buy or sell your Apple shares on any given day. It could mean that the price changes will be greater during the day than a stock that doesn't trade quite as much. Um, Certainly if you're looking at companies that aren't as well known, perhaps smaller companies, this volume of trades number can become more important in that it starts to tell you how easy or hard it might be to get out of an investment if you needed to do so. And those companies that don't trade very often are known as being thinly traded. And again, they tend to be smaller, less well-known companies, but it's something you'd want to look at if you were looking at an individual stock. And let's see, let's look at some other things here. The 1 day range um, is that's where the stock is traded just in this day, March 26th, anywhere from 166 to 169. So you can see it's already had some change during the day. And then the 52-week range. This is really where that stock price has been over the last year. It's been as low, looks like, as 138 and as high as 183. So again, these are just some data points that you can look at when you're evaluating individual stocks. And here are some more key stock data points that you might want to understand. You may often hear about the price earnings ratio or PE ratio. And this is really just the PE ratio tells you how much an investor is willing to pay per each dollar of the company's earnings. So, for instance, let's talk about that a little bit. If you see over on the right, you see EPS and for $9.73. This is the earnings per share. So for every share of Apple stock, Apple currently is earning $9.73 in revenue. This is not what's paid to you, by the way. It's not the dividend. It's not what's paid to you. It just tells you how much money the company is making in profits uh, per share or divided by the number of shares owned. Higher is better here on EPS. So knowing that EPS number, we want to find out how much are investors willing to pay for each dollar of earnings. So knowing that Apple earns $9.73 per share, how much am I willing to pay for that $9.73? And this is a fairly straightforward calculation. You can see if you wanted to calculate the PE ratio, if you just took the current price of Apple, which we said was $168.99 on the previous page, and we divided that by $9.73, we would come up with that 17.36 or 17 times earnings. So why do we care about that? Well, the historical average PE ratio across the whole market, the whole stock market, is around 15. So what that tells me right there is Apple might be trading a little bit higher than the average across the whole stock market. People are willing to pay a little bit maybe of a premium for Apple, probably because they think the future growth in Apple is gonna outpace the rise in the future stock price. And so they're willing to pay a little bit extra. But But in addition to just comparing across the whole market, you also want to look and see what the average PE ratio is for stocks in the same industry. Because, for instance, in the technology industry, the PE ratios have often tended to be higher than the average. So maybe, in fact, Apple is right in line with other companies similar to it in the same industry. But it's starting to tell you whether a stock is currently overpriced, maybe underpriced compared to its competitors. So again, just one more data point. Let's see, we talked about EPS and how higher is better there. Um, Market cap. Now, this is where we talked about trying to have different sized companies in your portfolio. And market cap is simply the market value of all the shares that are outstanding. So it kind of tells you how big or small the company is. For instance, when people talk about a large cap or blue chip stock, they typically are talking about companies where the market cap or the market value of all their shares is 10 billion or more. Um, the market cap here for Apple is 836 billion. Then there's mid-cap. Mid-cap stocks tend to be between 2 and 10 billion. And then small cap is often under 2 billion. And then you may also even hear about micro cap or nano cap. These again are publicly traded companies. You can buy their stock, but they're very small market cap companies or value. And you certainly in a portfolio want to have varying amounts of perhaps each of these types. Okay, let's talk just for a minute about yield and dividend. We mentioned dividends earlier, and you can see here the latest dividend for Apple is 63 cents. And usually dividends are paid quarterly so that you could figure out the annual dividend by just multiplying that 63 times 4. That gives us about $2.52. And then you take that number and you simply divide it by the current price. If you were to buy Apple today, how much would your dividend yield be? And in this case, you would be earning in dividends about 1.5% or 1.49%. And that's your yield. Again, we tend to compare those yields on the dividend income to what we might be getting in other places, such as bonds or bank accounts, etc. Okay, so a few other terms to know. You often hear about initial public offerings or IPOs. I think we've recently had Spotify and Dropbox IPOs, got a lot of press. This is really just when a company, usually private company usually, first offers its shares to the public, when you have the first opportunity as an individual investor to buy shares in a company. Then we have these different indices that you will often hear about, how the market's doing, and they all work a little bit differently. The Dow Jones Industrial Average, or the Dow, or the DJIA, is the oldest. It's really only 30 significant U.S. stocks that are traded on the New York Stock Exchange. I think a couple may also now be on the NASDAQ exchange. But it was started, actually kind of interesting, it was started by Charles Dow in 1896. So it's been around for a while. And it only had 12 stocks in it originally, mainly industrial stocks. And it's really kind of an indicator of overall market trends now. When they say the Dow is up or the Dow is down, you can now understand it's really a fairly narrow group of stocks. And in fact, there's only one original company still included in the Dow Jones, and that happens to be GE. The NASDAQ is what we consider the tech stock index. It has about 3,000 stocks in it. That are all traded on the NASDAQ stock exchange. But that tends to reflect what's happening in the tech industry. The S&P 500 index is just that, an index of 500 large U.S. companies. It tends to be the most common benchmark used by institutional investors to represent what's happening in the U.S. stock market as a whole. And then another common one that may not be quite as common as the US indices is the MSCI All Country World Index ex US. So this is a way to benchmark or capture performance in the international or global stock world. So all those companies that that may be publicly traded outside of the US. So that's usually benchmarked against your international pieces of your portfolio. And there are certainly many other indices that we use to reflect certain performance in certain sectors, but these tend to be the most common and the ones you're most likely to hear about. Okay, well, a very brief overview of stocks and some terms. And there are certainly at the end here, I'll show you some more resources if you want to dig deeper in learning how to be an individual stock investor. But now we're going to turn to bonds. So what is a bond? A bond is really simply a loan of money to a company. So rather than owning that company in the form of a stock share, a bond is you have loaned money to a company or the federal government or a municipality. And certainly bonds work very differently than stocks. They pay interest rather than dividends, and they pay interest at a stated annual rate. You know when you buy a bond what you're going to get because it's not going to change the entire time you own the bond. And it can be priced. You can buy a bond at par, you can buy it at a discount, or you can buy it at a premium. And we're going to walk through a little example on the next screen of all of those. Hopefully that will be clearer. And you can buy, there are very many types of bonds. There are US Treasury bonds, which are usually considered to be the safest. And because they are so safe, backed by the US government, they pay the lowest interest rate. Um, for instance, the 30-year Treasury rate right now is around 3%, paying 3% to lock up your money or loan your money to the US Treasury for 30 years. Municipal bonds, or munis, are bonds that are issued by state and local governments. So investors like munis, investors in higher tax brackets like munis, because they come with a tax advantage. Whenever you own a muni, the interest a municipal bond pays is going to be federally income tax free. So you're not paying income tax to the IRS on any interest you earn. And then it can even be what they call double tax free if you've bought a muni bond issued by a local or state municipality in your own state. So for instance, in Massachusetts, if you buy a Massachusetts muni bond, then not only is the interest tax-free at the federal level, but it is also state income tax-free. So that's a big advantage, especially right now, I think, because munis are paying municipal, like the national average for a 30-year AAA muni is also 3%, just like the Treasury. And yet I get a tax advantage because I don't have to pay federal income tax on that interest. So it's really going to feel like I'm earning maybe 5 to 6% uh, on that bond, depending on my tax bracket. So a good source of income, tax-free income for higher net worth investors. Corporate bonds. Corporate bonds are the bonds issued by companies like Apple. For instance, Apple happens to have a 25-year bond out there that's paying 3.85%. So again, corporations tend, because they're a little bit riskier compared to government bonds, tend to have to pay a little bit more interest to their bondholders than the government does. And then you have high yield bonds. High yield bonds are issued by companies that maybe have a little bit lower debt rating. They're definitely riskier. They're not in such as good a financial shape, and they need to borrow the money, so they have to pay usually a significantly more interest in order to get people to buy their bonds. So that can even be as high as, say, 7% or more. You certainly, in that case, you're taking on more risk in your bond portfolio, so you wouldn't necessarily want to only buy high yield bonds. And then finally, there are zero coupon bonds where no interest is paid, but you buy it at a steep discount, and your return is really received by the gradual appreciation of the bond until maturity. We don't see that as much in low interest rate environments because the appreciation won't always keep up with inflation. So all these bonds are issued at different maturities. You can lock in the rate for a long time, probably up to 30 years, or a short time, which can be very short, a year, 2 years, 3 years. And we'll talk about what types of environments are best for both of those. So I wanted to cover just a quick bond example because I know we often get lots of questions on how bonds work. Um, and really, as I said, you can purchase a bond at par, which simply means you're buying that bond at its face value. So let's assume you purchase a $10,000 bond and it is paying 5% interest a year. So buying at par, you're going to pay $10,000. You get to earn $500 each year. You know you're going to get that. And then when the bond matures, you're going to get your $10,000 back. This means that your yield to maturity, which is another term often used in the bond world, is 5%, just what they stated it to be. But what if you bought that bond at a discount? If you bought it at a discount, maybe you only had to pay $9,700 for it. You're still going to get that $500 because that's the stated rate on the face value, and you're actually going to get $10,000 back at maturity. So you really kind of earned an extra $300 there through the life of the bond. And so your yield to maturity is a little bit higher than the 5%. It's 5.15. Conversely, if you're buying a bond at a premium, you're going to pay more than the face value, perhaps because that bond is paying a little bit more interest than is typical right now on new bonds. And so you're still going to earn 500, you're still going to get 10,000 back at maturity, but really your true return or your true yield to maturity is only 4.9%. So this is really important to look at when you are buying bonds. Um, Now, you can hold these bonds. Let's say this is a $10,000 bond for 10 years. Um, During those 10 years, you're always going to get that $500 each year, no matter what the price of the bond is. But the price or the value of the bond can really fluctuate each year depending on what interest rates are doing. When rates go up, bond values tend to go down, and we're starting to see some of this in the markets right now as interest rates creep up. Existing bonds aren't quite as valuable as new bonds that get issued at those higher rates. So if you are owning bonds, you may initially see a decrease in your value. However, if you hold that bond until maturity, you're going to get the face value back regardless of how the value fluctuated while you held it. So it's important to remember that bonds pricing works differently, and you really want to understand what your true yield to maturity is, not just the face value that it's paying, and understand how the value may fluctuate while you hold it due to rising or falling interest rates. So, why is all that important? Well, if you expect rates to continue to go up or to go up soon, you wouldn't want to lock in your current rate for 30 years. You probably would not want to buy a 30-year bond when you know interest rates are going to go up, because that means you're really going to get stuck with a lower paying interest rate down the road than what the current rate might be. So you would probably want to stick with shorter maturity bonds so that when they mature, you can reinvest that money in higher yielding bonds, assuming rates are going up. And so, for instance, if you think about that, on April 1st, 20 years ago, that 30-year treasury we talked about was paying almost 6% in interest. Now, a 30-year treasury is only paying 3% in interest. So, had you bought a 30-year treasury back 20 years ago, you would have been receiving 6% a year, and that would look pretty good right now as rates had fallen over that time. The reverse may be true going forward over the next 20 years. Okay, why own bonds? Well, we've talked about some of the pros. You certainly know what income you're going to be getting from a bond on day one. You don't buy bonds for growth, you buy them for the income and for some downside protection, some safety. And I think it's important to remember what that bond is, why bonds are in your portfolio. It definitely gives you downside protection because default rates on most bonds are very, very low. They're not like a stock where if the stock goes bankrupt, you lose all your money. If a company that issued a bond went bankrupt, uh, bondholders actually have higher priority to get some of their money back than the stockholders in that same company. But again, default rates are very low to begin with on most types of bonds. Um, you can also ladder maturities to always be getting bonds and new bonds at current interest rates. And let's see what else. Yes, and then often the values move inversely to stocks, although that's not always true. We certainly didn't see that in '08, and there have been periods of time where that's not true. But bonds will fluctuate, but certainly not as volatile as stocks. Okay, what are the downsides to owning bonds? Well, certainly right now, current interest rates are still pretty low. They've been very low, and therefore have not really kept up with inflation. We mentioned inflation right now is about 2.2%. And yet you'd have to buy a fairly long-term bond to get over 2.2%. So they are not a good inflation hedge. Um, Short-term bonds, where most people want to be right now because they do anticipate increase in interest rates, short-term bonds, again, do not pay a lot of interest. And there's no growth. This is not an investment that you're buying for growth. So you can lose purchasing power over time because of inflation. And, let's face it, I mean, a lot of people find bonds boring. Um, they're not quite as much fun to talk about as individual stocks, but they are an important part of your portfolio, and they can provide a fixed income that's very reliable, as well as I said, downside protection against declines in the stock market. So a couple of other very common types of investments we see in most portfolios and that you likely own yourself are mutual funds and exchange traded funds. And I won't spend a lot of time talking about these, but they really are just baskets of stocks or bonds. So when you have smaller amounts of money or you don't necessarily want to do a lot of research on individual stocks and bonds, mutual funds are a great way to get instant diversification. They're also very helpful to get exposure to markets that may be a little bit harder to really research and know what to buy in those markets, such as global markets or maybe small cap markets. Mutual funds and ETFs can be actively managed by a portfolio manager or a team, or they could passively follow an index. So they come in both flavors. Um, and again, great for harder to research areas and instant diversification. So as planners, we look at all types of investments when we're looking at a client's portfolio and understanding the diversification of a portfolio. So these are also types of investments we do consider. that you might have or might need to round out a truly diversified portfolio. Real estate, certainly. I always say your house is not really shouldn't really be included in an investment portfolio because you have to have somewhere to live. But certainly, if you have multiple homes or are investing in commercial property, that is definitely part of your portfolio. Options and futures are sometimes appropriate in a portfolio. Commodities, um, such as oil, gas, copper, uh, hedge funds, artwork, and even coins and other collectibles, when significant, should be factored into your overall portfolio in terms of diversification and understanding where you may have exposure or too much exposure to one type. Okay, so when you're putting together a portfolio, there are just a few things to remember, whether you're using stocks, bonds, mutual funds, ETFs, some of those other types of investments. Um, you really want to, first of all, don't take stock tips in isolation. That tends to be something we all like to do. Your neighbor's situation may not be yours, and you what may be right for one person may not be right for you. So you want to start with your goals, your dreams. You know, these investments are just the tools to help you realize those dreams. So you want to know how much you're going to need and when you're going to need it, and that should really dictate the riskiness of your portfolio, uh, the balance, the diversification, making sure you have the money you need when you need it. Part of this is also understanding your particular tolerance for taking risk. Um, the more risk you take with the balance in your portfolio of stocks versus bonds or types of stocks can mean higher potential returns, but it can also mean bigger losses, as we all saw during '08 and '09. So it's really important to figure out really two questions around risk. How much risk do you need to take to accomplish your goals? And how much do you want to take? And sometimes those are two different answers. Um, and it can be difficult because depending on how we're feeling about things overall, it can be difficult to assess. So you want to have a periodic conversation about this. If you need to earn 7% a year, for instance, you're going to have to take on more risk in your portfolio to get there. But if you only need to earn 3% a year on your investments to have enough money to do the things you want to do now and in the future, then you can tell yourself, well, why do I need to take on more risk? So again, a good question to have with yourself and with your advisor. Um, Finally, the key, which I've talked about a few times here, is inflation. Inflation erodes purchasing power, and women, unfortunately, often tend to leave too much in cash to be safe, or as we said earlier, can sometimes invest too conservatively for the goals they have and the risk they should be taking on to achieve those goals, and to make sure that if they are 95 years old, that they have kept up with inflation and can continue to afford those things that they were able to afford earlier. And my mantra, which I talk about all the time with clients, especially when markets are volatile, is that time in the market, not timing the market, is what builds wealth. So I wanted to just provide you with a few resources for additional investment knowledge if you want to learn a little bit more. Obviously, we at North American Management are always standing by to answer your investment questions. We also have lots of information on our website now, namcorp.com. Fidelity has a women-centric website called It's Time. I would highly recommend that. I'm a big fan of the Wall Street Journal, both online and in print. I may be the only person reading it in print anymore, but it does have a lot of good information on what's happening both in economic trends as well as individual companies. A couple of female authors who write for women in particular, and how to feel more comfortable and smart about investing are listed here. And then one of my old favorites, Peter Lynch, the old Fidelity Magellan manager in the 1980s. He wrote a great book if you're starting out with individual investing called One Up on Wall Street, basically saying invest in what you know and understand. So I would really still like that book. And then finally, Morningstar put out a report in 2017 called Fundamentals for Investors, which has a lot of good information on it as well. And then I did just want to provide the calendar of the rest of the webinar series. May 16, we're doing a discussion on budgets and different ways to budget, hopefully help you find a way that works for you. Avoiding financial catastrophe. This is really going to talk about, what you should be doing in terms of perhaps insurance, and what's enough, what's too much. Managing a nonlinear career. I'm very excited about this one because a lot of women go in and out of the workforce as they manage home and family obligations, and some things that you can do to help there. Eavesdropping at your funeral. This is really, what do you want your legacy to be, and how do you go about setting that up while you're still alive? Having better money conversations. This is better money conversations as couples, as with children, and making sure that you're having healthy money conversations as you go along. Preparing for longevity. Well, we talked about women perhaps living to 95 and older. What are some things really that you need to be thinking about to be prepared, and hopefully to enjoy those latter years in your life? And then finally, in December, we're gonna do something on, is there such a thing as good debt, and how do you look at the debt side of your balance sheet? So we hope you'll be able to join us for each and all of these webinars. We'll be sending out additional information as each one gets closer. And then finally, I'll just leave this up for a minute. If you have any further questions on investments and what we've covered today, as well as any of these future topics I just mentioned, please feel free to reach out to me at the email or the phone number here, and I'd be happy to get back to you, to add your friends and family to our mailing list for these webinars. Just let me know. Thank you for joining us today.